Morning everybody, Dwayne Shepherd here, DRFX Trading. Today I'm going to take a look at the situation that has taken place on the New Zealand dollar Canadian pair over the last several weeks. Looking at this graph, we can see that the last time we took a look at this pair, there was a gradual movement and a gradual reversal following the false breakout attempt above the resistance boundary. Here we see that the market had actually started to move out bullish, but these bullish candles were eventually taken out by the reversal that carried us back below the resistance boundary and inside of the pennant. Now, based on this setup and based on what we were seeing in terms of this reversal, we had projected that the market would actually break that support boundary, break this downtrend line that was formed, as well as this, and then head towards this major outer uptrend line. The theory behind this projection had to do with what generally takes place with false breakouts. In general, false breakouts essentially take place when the market attempts to break out in one direction from the pennant and is taken out by a reversal candle that takes us back inside of the pennant. Generally, what takes place is that the market, in pulling back inside of that consolidation boundary, will tend to break out at the other end very sharply for hundreds of pips. Taking a look at what actually took place, we can actually see that that is exactly what took place on this pair. The market eventually broke this support point, broke this downtrend line, and came very close to this outer uptrend line, which we can see has been in place for a very long time, since early 2009. So this projection played out as expected. This decline in the market played out as expected, and overall this led to a decline of approximately 800 pips from the high of that previous false breakout. Now, depending on your trading strategy, you could have taken advantage of this movement in several ways. One way would have been to enter here in anticipation of that decline, having seen the start of this false breakout. Another way, which would have been a little more conservative, would have been to wait until you got confirmation that the market was actually heading in this direction after the break of this support point. The reason for this is that even though in the majority of cases when a false breakout takes place, the market will break out to the other end. There are times when the market will move within this boundary for a very long time before actually breaking out. So the better option, in my opinion, would have been to do this, would have been to wait until the market actually broke the barrier to confirm the start of this false breakout to the other end, at the other end. So, in terms of this way of trading, what you could have done is drawn the downtrend lines which would have been formed along the way. Here we see that we have an outer downtrend line and two inner downtrend lines here. So one way to have taken advantage of this nice drop in this pair would have been to enter at this area and place a stop loss just above this downtrend line. So if your entry was here at, say, the 91 area, you would have placed a stop of approximately 100 pips above this inner downtrend line, and as the market continued to move in your favor, what you would have done is simply move that stop loss along the way, locking in your profits. So the first thing to have done would have been to break even here and then move and then lock in profits as the market continues to drop in your favor. This could have continued along up to this area here at the $88 area, by which time you would have captured approximately 300 pips. The market would have reversed and taken out your stop loss, but this would have been one of those instances in which you would not have been very disappointed if when your stop loss is taken out, because in this case you would have captured a very large and handsome 300 pips. So that is one way in which you could have locked in profits and taken advantage of this decline in the market. Another way would have been to use a 4-hour chart in assisting you in placing your stop loss. As you see here, that same downtrend line that would have been used on the daily chart was accompanied by the formation of these setups along in the 4-hour on the 4-hour chart as well. Here we see a pennant setup and a range setup that were formed as a market decline. The highs of these areas could have been used as stop loss areas as well. The resistance boundary of this pennant could have been used, followed by the resistance of this range, as well as as the market broke out from these setups here. So the use of this trend line as well as these pennant setups along the 4-hour chart could have assisted you in moving your stop loss along the way as the market moved in your favor to capture that very large profit from this trade. So that was the situation that unfolded on the New Zealand Canada based on the projected decline and based on the theory of false breakouts. So throughout the market, you're gonna see a lot of consolidation patterns developing on several of the most popular pairs. So this is one way in which you could have taken advantage of. You can take advantage of these breakouts, and throughout the course of the next few days, I'll take a look at other situations that are presenting themselves, that might present themselves in this way, and we can take advantage of them in just the way that I showed here. So until then, take care.